The output gap is the difference between the real gross domestic product growth rate and the potential growth rate when the economy is operating at full capacity. In other words, it is also called the GDP gap. A positive output gap is interpreted as a signal of inflation, meaning real demand exceeds supply. If it is positive, there is a high possibility of inflation, and if it is negative, there is a high possibility of deflation. Potential GDP refers to the total production volume that can be achieved by maximizing all production factors that can be mobilized in a country, such as capital and labor. The premise here is that there will be no side effects, such as unemployment and inflation. A positive output gap means that real GDP growth exceeds potential GDP growth. In this case, it is seen that country's production factors have been input more than normal, and it is interpreted that the country's economy is in an overheated state. Conversely, if the output gap is negative, it can be seen that the country is in an economic recession because it is unable to use all of its potentially available production factors. Japan's Cabinet Office announced on August 16th that real GDP in the second quarter, excluding the impact of price fluctuations, increased by 1.5% compared to the previous quarter, hitting an all-time high. This figure is nearly double the expected 0.8%. The positive streak continued for 3 consecutive quarters. Personal consumption, which accounts for more than half of GDP, decreased, but exports increased significantly due to the weak yen, boosting the overall growth rate. It was analyzed that Japan's exports in the second quarter increased by 3.2% compared to the previous quarter, and the entry of foreign travelers who are statistically considered exports also increased significantly. On the other hand, income decreased by more than 4%. Japan's GDP growth rate was 0.9% in the first quarter of this year, exceeding Korea's 0.3% and also numerically ahead in the second quarter at 1.5% to 0.6%. If this trend continued, Japan's growth rate this year will surpass Korea's for the first time since the 1998 foreign exchange crisis. Additionally, Japan's economy is starting to send signs of stimulating inflation for the first time in nearly 4 years. Japan's Cabinet Office announced on September 1st that the GDP output gap recorded 0.4% in the second quarter. This is the first positive figure since the third quarter of 2019. The Bank of Japan calculates the output gap on a quarterly basis, separating from the Cabinet Office. the Bank of Japan calculated the output gap for the first quarter of this year to be minus 0.34%. If the Japanese economy emerges from a long recession and transitions to an inflationary pace, monetary policy may also change. The Bank of Japan continues its easing monetary policy despite rising inflation exceeding the target price of 2%. The Bank of Japan believes that the inflation factor is greater due to rising costs rather than increased demand. The Bank of Japan has maintained a large-scale monetary easing policy until there are signs of sustainable inflation driven by rising wages. Also, unlike other central banks, the Bank of Japan is taking a policy of keeping government bond yields as low as possible, thereby encouraging the weakening of the yen. However, if Japan's output gap turns positive and continues to exceed the 2% inflation target, there is a possibility that the monetary policy change will be accelerated. Japan is benefiting in terms of trade balance from its continued low yen policy. In terms of external balance, it is also advantageous in terms of balance other than trade, such as the influx of tourists. On the other hand, import prices are rising, including the rising cost of importing crude oil, increasing the inflationary pressure on the cost side that Governor Ueda is concerned about.